What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is July 31st of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about a potential major liquidation event that could be on the horizon here for cryptocurrencies over the next couple of weeks and months, especially if Bitcoin does not get a bid here over the next few weeks. I want to spend some time to look at the on-chain metrics that I feel no one is covering at the moment, and how some of the biggest debt positions in the DeFi sector are just a mere couple $100s away from a major liquidation event when it comes to Ethereum's price. We got a lot of things to dive into in today's video. If you guys haven't already, consider dropping a like. It's one of the greatest ways you guys can support the channel and the content we create here. And let's go ahead and kick off the rambling. All right, so I don't want to spend too much time here on Bitcoin here as we kick off Monday. You guys know what our thesis is here. If you've been watching the last couple of videos, we go to the weekly time frame. Again, still not getting a bid to drive up towards the upper part of that resistance band. We have still not had any period of time where Bitcoin has been able to reclaim that price territory. We've been kind of in the middle here, and every single time since back in April, we continue to fade here and essentially see that there is more supply on the market than demand. Price is telling us this. If there is going to be a bidder coming, we haven't seen them yet in price, and that time window is fading here. If we do not get support here on this band and start to rebound, whether it be the long-term resistance band turning it into new support, or that the ascending channel gets broken, we are expecting we're going to come down into much deeper capitulation territory, at a minimum into that 18-20K range, but we're really shooting for new lows in this cycle, guys. And I want to spend some time to talk about why that could very well be. Let's go ahead and talk here about the current state of the market, and we're going to dive into this topic of the liquidation event. Generally speaking here, altcoins after the XRP news, right, this is excluding ETH, just looking at the pure altcoin market here, we can see are down around $27 billion from their relative peak here in July, which took us back to where we were back in April of 2023. But since then, we have faded those gains and are only up roughly about $19 billion from those prior lows. The majority of that valuation gain really being in XRP, which, well, as you guys know at this point, at the end of the day, XRP itself is almost in its own right. It's a different cryptocurrency from many others because they use some of the most advanced market making technology, whole range of stuff that, again, I understand that there are some who like XRP, but we'll put aside my opinions. You guys have heard me talk about it before. At the end of the day, a lot of that valuation, in my opinion, is not real. The key thing here, though, is whether or not you agree or disagree with me on that, we've got to look here at the general line of support. You can draw it any way you want here, but generally speaking, we are getting towards that line of support potentially breaking unless we get a bid to drive up prices here. If we can't clear through this upward band that is descending resistance, mind you, which has been, basically tolerating the price is going to be moving lower here in the short term. It just needs to get a slight bit higher in order to confirm that confidence. If we can't get that and we break through this line, don't be so surprised if we come down and see new lows coming down towards around $145 to $150 billion. The reason we need to be cautious about this, guys, is because of the potential ramifications that it can mean for our portfolios, the wealth we've built over the past couple of years, and maybe for those of you who are just getting started, you want to make sure that if you're getting started in crypto or really trying to build that substantial kind of portfolio where you can hopefully make it long term, you don't want to get trapped chasing what looks like the final dip, but in reality is just yet another relief rally. There have been multiple here for altcoins, each and every time setting lower lows and lower highs. Now, I want to go ahead here and talk a little bit about Ethereum. You guys know we have been kind of beating it like a dead horse that we expect another 20% correction in Ethereum against Bitcoin's price, and with that, we need to understand that we've also been calling for the idea that Bitcoin is going to be catching a lower bid, meaning that prices are going to go lower, and therefore Ethereum is going to get hit even harder. And a lot of these narratives are on ETH2, or in this case, proof of stake, lowering the inflation rate, EIP 1559 potentially making Ethereum deflationary. While all these things are great, the DeFi ecosystem and development on Ethereum is dead right now, guys. I mean, it's really at a fraction of where it's been. I saw a chart the other day, and I think this plays into Ethereum's price here, that we've had the lowest amount of new startups fundraising in the crypto space since 2015. The venture capital industry, not just around DeFi, but the whole crypto sector has practically vanished compared to where it was just about a year or two ago. And this is where I get back to this point here. You can have as much deflationary weight. You could literally be removing 5% of the supply each and every year. But if there are 5% more sellers than net buyers on an annualized basis, prices are going to remain neutral at that point. They're not going to progress. And if you start to have the reality here, which is that Ethereum's barely deflationary sometimes, if you have a massive amount of sellers versus market buyers, prices will go down. There's always a match on either side of the trade, but it's a matter of where the market order flow pressure is. Who's making the market orders, the bulls or the bears? Because if people are selling here, it's going to drag down prices, right? If people are market selling. So this is our conservative target, because this is the long-term trend line. But I want to spend some time today to talk about a potential chance that this could break and that we could be coming down towards an even lower level. A potential 50% decline from current valuations, or roughly around 40%. Sorry for the improper math there. But generally speaking, around a 33–40% decline here from those prior relative price range that we're at right now. And I want to spend some time to talk about why that is. We need to talk about on-chain metrics when it comes to DeFi. Now, there has been a broad assumption here for the past couple of months, since back in November, and that is that, Nick, come on now. It's a new bull market, it's time to get excited, and it's time to be a little bit more complacent. Time to start betting on those risky altcoins, time to start positioning ourselves for the next cycle. We don't want to miss out. After all, the Fed has dealt with inflation. The Fed has now been in a position where it can finally start to pivot on its monetary policy. There's de-dollarization, there's the Bitcoin BlackRock ETF, there's the Bitcoin bank run. What's not to love, right? And the XRP news, mind you, as well. All these great narratives, right, that people are so juiced up about have left people getting back in the same risk-taking mindset that caused the severe mid-cycle corrections of the last cycle. And that's taking on debt. Now, I'll tell you guys this from experience. I know it firsthand because I've lost money before trading with leverage, trying to take out creditor loans here within the market. No worries, I haven't taken out any traditional bank loans or to refinance my house or something, but you get the point here. I've dabbled around with credit in the DeFi space before, and I gotta tell you guys, it is a recipe for disaster. It is one of the best use cases in crypto, but unfortunately most people don't know how to manage it. And I want to talk again about how here on tools like DeFi Llama, we can see here that there's really great visualizations here to figure out when essentially we are expecting some type of major sell-off event at certain price thresholds. We can see that there are some pretty big leaps here as we progress downward on Ethereum's price, where there are going to be liquidations across a whole range of different DeFi protocols like MakerDAO, Liquidity, as well as Aave v2. Now, I want to go ahead and bring your guys' attention to something big here, which is there are two major platforms that really have me concerned and make the majority of the weight here of our concern. And the way we find this out here is by simply clicking on the amount within a 20% decline. So this means that the amount of DeFi loans that are out there that are going to get liquidated, positions, right, that are going to get liquidated if there's a 20% decline. Now we need to take a step back here before I show you these metrics. We dive into the different websites. For those who may not know, in order to take a loan out in the DeFi industry, right, in order to go out and borrow a huge amount of stable coins, whether they be decentralized stable coins like DAI or centralized ones like USDT, USDC, you name it, anyone you can think about out there, any of the stable coins, which is the majority of which what people are borrowing, people are going to lock in crypto assets. In the vast majority of cases, 2/3 of the cases here, that is going to be Ethereum. It's going to be either staked Ethereum, right, that's wrapped here essentially, so it's kind of the IOU claim on all that staked ETH that's earning 5%, right? And also there's wrapped ETH, right? So sorry, I don't know why I knocked me on the page there. So we can see, again, generally speaking, that about 2/3 of it was Ethereum, okay? So now that we understand that here, we can start to understand that Ethereum's price declining, right, is going to be detrimental for these loans, because if the collateral, which already has to be over collateralized versus what they're borrowing, so the only real use case here is that people are essentially putting up their ETH into these DeFi protocols. They're relinquishing it for the short term, right? And they're getting a certain amount of stable coins, a lower amount of stable coins, in order to go out there and maybe buy more Ethereum and speculate, and then eventually pay down the loan and get their collateral back. That's the general use case here. But what happens is if it goes the other way, if the Ethereum, the collateral goes down low enough and the debt to loan ratio starts to get too absorbent here, essentially you don't have enough collateral to back up the debt you took out, then there's going to be a liquidation event, unless you can refinance it, right? Unless you can put in more DAI and pay down that loan, which many of these players do not have, right? So I want to go ahead here and talk about the couple different scenarios here, right? And once we understand here, once we measure, which protocols are going to be most impacted here by a 20% decline in ETH, we can see that it's quite clear here. The vast majority of that liquidity comes in from two protocols, or really three protocols here, which are Aave, V2, MakerDAO, and Compound. These are three of the largest DeFi protocols, and there's nothing against them here. I'm not bashing these three protocols, but there is a large amount of debt here that will get liquidated. Over $100 million worth of ETH that will get liquidated here, right, within a 20% decline. And an even bigger set of debt here, nearly, I think, well over $1.2 billion of liquidity that will get knocked out on these protocols if we see a cascade of continued price decline. Now, not all of that is going to get declined. Some of those loans were opened up a long time ago. And as you can see, as we go throughout here, there is still a substantial amount that wouldn't get liquidated until we got to, say, $500 or $600 of Ethereum, right? I'm not here to say that it's going to go all the way down there, guys. I'm not here to make some doomsday scenario. What I am here to say, though, is that there's a pretty sizable amount of debt that can get liquidated up here. It may not look like much, but if we start to get down here, liquidations can act as a cascading effect. And it's important to observe some of the biggest debt positions in the crypto sector right now, because two of the largest on MakerDAO have liquidation prices around $1,100 to $1,200. Now, it could be that they start to redeposit some of the DAI back on their positions. Maybe that lowers the liquidation price. Sure. But if these people have been positioning themselves with that borrowed DAI in order to buy more Ethereum, that is still going to cause a sell side pressure on the market. And that's the key point here. I want to talk about debt, guys, because if people are opening these positions in the hundreds of millions, tens of millions, right? Just by one single debt position here. This is one where they used 60,800 Ethereum in order to take out $51 million worth of DAI. Now, currently it's at a ratio of 221%, meaning that essentially the liquidation price right now is $1,222. But if we take a look here, this position has been open for some time. And as you can see throughout history, this loan was really at a healthy ratio for a long time. Even during the COVID collapse, it was higher essentially than where it is here today, right? During this period of time. So well back here into 2020, right? We can see during the COVID collapse, we can see here as well during October 2020, before the altcoin surge, we were at much healthier ratios, well over 350% here at those lows. The unfortunate thing, though, is that the person who owns this position was in a very cozy position for a long period of time. They had a sizable ETH position, and essentially, they didn't borrow much DAI at the beginning. So as the ETH appreciated here, they could really start to take out a ton of DAI here because they were way over collateralized. The ETH they were holding was worth so much. So if we take a look at their history, they generated DAI. Essentially day by day here, or like week by week here, you can essentially see there are these different time thresholds where essentially they opened up, $1 million DAI positions, 500,000 DAI, pretty casually, and sometimes paying back certain amounts of DAI. But generally speaking, generating DAI throughout its history, lowering that debt to that CDP ratio here, right? The collateral to debt ratio that we have within the position down to a mere 221%. Now it sounds like a lot, but when you consider that just a couple months ago, that same position back in, say, August of last year was 470%, the person managing this position is likely doing the obvious. They are stacking a big position in Ethereum. They are betting that the cycle lows are in. And I understand some people would say, oh, Nick, this is the smart money here. The smart money must know that the market's going to wire. I got to tell you guys something. Smart money doesn't borrow in order to speculate. Smart money borrows money to go long on equities when we're in a clear bull run, not in trying to find the lows. And this participant in the market, we don't know who they are, right? They're hiding behind some wallet address here. If ETH starts to go south, they've got to start covering which means that any assets that they bought with that DAI, they're going to have to sell as fast as possible, and they're going to hope to be able to pay down that debt enough to where the liquidation price moves lower. It doesn't matter if the loan gets liquidated or not. There is a lot of potential downward pressure from this. Another position, which is more than twice that size, 124 million DAI borrowed with 161,990 synthetic wrapped ETH. Excuse me, staked ETH here in this case, right? Wrapped staked ETH, right? $124 million at a mere debt to collateralization ratio of 279%. Now, this is again a bit healthier than the prior loan here, and it is going to mean that Ethereum needs to decline about another $100 from the point of the other loan here, about 80 bucks more. So 1,149. But again, the key thing here is while this one is much more actively managed, at the end of the day, the only use case, those people aren't using DAI to go out and pay for business expenses, or they're not going out there and using it to lend capital to some emerging market DeFi protocol that really touches the real world, has real value creation. No, these kind of use cases for DAI, unfortunately, because DeFi has been so stagnant over the past couple of years and it's just become a casino of speculation, essentially means that if they've done anything with that DAI, they've bought crypto assets most likely. And if that's the case, or whatever activities they're doing, if they haven't made a profit, or if they start to lose money and bleed money, they're going to have to be more and more diligent about covering those loans. And that is going to essentially take more stablecoin liquidity out of the market. It's going to put downward pressure on the assets they have as collateral within the protocol, and it's going to weigh down cryptocurrency valuations in an already relatively illiquid market. It just takes one big sell-off here to cause this scare. And you guys remembered this back in 2020 and 2021 and 2022 as debt became a bigger part of the crypto space. Unfortunately, we repeated the same mistakes of traditional finance where debt got to unhealthy levels and it caused liquidation events. We have still not been able to, for more than a year and 2 months, clear through this resistance range at 2,000. Many people say that XRP won the case, right? That Ripple essentially won this case against the SEC. And this was the breakthrough moment for altcoins. This changed the game, the narrative. I heard from so many people on crypto Twitter and the crypto space just saying, oh, it's a slam dunk guarantee, as they always do. And what happened? Well, we couldn't get a bid. We faded worse than we did back here in April. We made much more price progression. And again, back there, we had an engulfing candle, losing all of those gains. This time around, we just didn't even really get a bid. We went up a little bit, faded down the same exact day. So either one of two things has to happen. Either we have got to get something that's going to push us up above that resistance range and confirm what looks to be like a bullish pattern, an ascending triangle, or we've got to come down and retest this low range. Either we've got to get some buyers coming in here who feel that this is the last relative low before a breakout on this technical pattern, or we are going to start rolling through. We will have failed a more than year-long bullish pattern in price. And we will start a cascade of liquidations and sell-side pressure. And no EIP 1559, no staking reduction of inflation is going to save Ethereum from that. Because it comes back here towards the point that so many people want to ignore, which is that the fundamentals do come into check. When the markets become more bearish, when the liquidity contracts, and you don't have the easy money. It comes back to, hey, what new applications on Ethereum are we getting excited about? What new applications are generating revenue? Which ones are bringing in new users and new money? What's the new use case, the killer app that really back in 2020 was very clear? Uniswap, Compound, Aave, Maker, there was so many great applications. DeFi as a label became something, but we realized that it was a vacuum. It was a vortex of liquidity just circulating around. It didn't touch the real world. And unfortunately, that's still what it is today. It's unfortunately where Ethereum still is today. And not just Ethereum, but also the broader crypto space. And I think that is why we did not come up to test this range on the Crypto 10 index of 10,800 points. It's why we didn't come up here to test 13,200. And it's why we can't get past the 9,000 point range here on the index. It's because the market is not ready yet. I remember a quote from Vitalik when I think Ethereum had become the largest cryptocurrency, even above Bitcoin for a short window of time. And he put out this quote of saying, "No, do we deserve this? Does crypto really deserve these valuations? Have we earned it?" And shortly after, as Vitalik so eloquently put it, valuations contracted because the market didn't earn it. It was a bubble. And trust me, while we've cleared through the big bubble, no doubt about it, people can get wrecked big time off of these short-term rallies, hoping that it's a return to the norm. And they can completely neglect the fact that we can come right back down to the same capitulation range we came down before, and potentially even lower levels rather than higher ones. I'm not here to say that it's all doom and gloom, guys, but I gotta say, for those who are positioned too risk on here, too early on, getting too ahead of themselves, they can get caught in a messy position. Well, folks, I hope you enjoy my rambling here. If you guys enjoyed this video, consider dropping a like. And for those of you who made it this far, I want to ask you guys that if you're interested in getting more content like this, if you like these kind of ramble sessions where I go through and dive into topics that I feel a lot of people in the crypto space don't take the time to cover the dynamics of the market, I highly recommend you guys check out the Dash Report. This is our newsletter here on the DataDash channel. It is a 20-page plus report. We just dropped a new edition here for the month of August. And essentially speaking, within this report, it's going to cover all ranges of topics, mainly focusing in on one of the key elements here that is going to essentially be the driver and determiner of long-term bull markets, which unfortunately we are not seeing. In fact, we're seeing quite the opposite. It has to do with the topic of liquidity. And outside of that, we're also talking about some trending sectors that we feel could do a 20-50x over the next couple of years. And I gotta tell you guys, I'm gonna give you a hint, it's not cryptocurrencies. So this is why, again, we talk about the macro perspective. It's not crazy to think that there will be some plays that do these 10, 20, 50x's in returns. There will be lots of plays who do that, but you gotta know where to look for them. And unfortunately, they're not always in the crypto market. So we'll talk about what that sector is within the newsletter. And outside of that as well, you guys can get access towards our momentum indicator, the blue-red indicator that you commonly see within our videos. We'll give you access to that, plus an upgraded feature of it that has our pivot line letting you know when the indicator will flip, depending on which price level. So that's it for today's video, guys. I rambled on a good amount. Again, even if you can't sign up for the Dash Report, drop it a like. It's always appreciated. It's a great way to support the channel. And until the next video, guys, I'll see you on Wednesday. Trade safe, stay smart, and I'll see you all in the next video. Take care, everyone.